Good morning, November 4th, 2024. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. You can find me intra-week if there's something interesting to say. It doesn't happen every week, but I would be at LinkedIn, probably the best place. You can find me there, Herb Morgan, or on X at Herb W. Morgan. Let's move on. This presentation has been created by us, Cantor Fitzgerald Investment Advisors LP. We are an SEC registered investment advisor. It is designed to be used by individual investors, institutional investors, financial advisors, and consultants. Each are, of course, expected to make their own investment decision. Nothing contained in the presentation should be treated as investment advice, no tax advice, no recommendation for the purchase or sale of any securities. Let's get into it. We had a weak week. If you can say that, a week in equity prices. You could see the S&P down about 1.35%. Performing much better are the more volatile, higher beta indices of mid-cap and small-cap stocks. Why is that happening? Well, again, it's a broadening out of this bull market, the stock market rally that we're in, partly fueled, of course, by now a accommodative or less restrictive Federal Reserve policy. Let me turn off my phone beeping. Apologize for that. International markets down as well. Bond markets down on higher yields. 10-year Treasury yield got over 4.3% late last week, and that drove the 20-year plus Treasury bond index down about a full 1% on the week. Let's get into the economic data. We got quite a bit on residential real estate. Start with FHFA House Price Index. Remember, FHFA measures those home purchases and sales created by government-sponsored enterprise mortgages, GSE mortgages. They say in August, house prices gained 0.3%. That was triple the expectations of 0.1%, and home prices are 4.2% higher than they were a year ago. Case-Shiller Home Price Index up similar amount, 0.35%, and in this case up 5.2%. It's a broader base metric, but somewhere between 4 and 5.25% is what home prices did nationally over the last 12 months, ended at the end of August. And then in September, pending home sales really surged about 7.4%, well above the estimate of 1.9%. You can see it there. They're up 2.2% from a year ago. Why the big surge? Remember, the Federal Reserve was widely expected to meet and cut interest rates in September, and they did just that. So buyers rushed to lock in contracts. Then they're going to go out and try to find a mortgage. But what they're being hit with now is a surprise. Interest rates on mortgages are actually higher. Everything in the Treasury curve, other than up to about 6 months, 0 to 6 months, has gone lower because the Fed controls the federal funds rate, the short-term rate. Everything else outside of that has actually gone higher. Why? Expectations for higher inflation resulting from the Fed cutting interest rates and large expected government deficits and accumulation of government debt. Conference Board says that consumers were feeling a little bit better in October, and confidence rose from 99.2 to 108.7, well above the expectations. Why? Strong economy, strong labor market. The bottom line is the economy is really not in any immediate danger of entering into recession. The labor market remains incredibly resilient and strong. The services sector is absolutely booming. Consumers are nowhere near as confident as they were prior to COVID. You can see at really high numbers, 120, 130, 140, but it did shoot up last month on this strength in the labor market. Jobs easy to get was the component that the respondents replied to. Follow that with the monthly JOLTS or job openings report. Two ways to look at this. Glass half empty as we're down from 12 million to below 8 million. We came in at 7.443 in August. But in reality, that was an artificial surge related to the reopening after COVID. And we're really just down to where we were, exactly really where we were prior to the COVID-related shutdowns. So this is, in my opinion, not indicative of a weakening labor market, but indicative of a normalizing labor market. Don't forget, every Thursday at 5:30 a.m. Pacific time, we get initial claims for unemployment. And here we came in last week at 216,000. This is just historically low numbers, right? These numbers in this low 200 range that we've been at since 2000 and since the reopening after COVID are low by all historical standards, and show that the labor market continues to be resilient and strong and jobs available are good. Continuing claims are down at a pretty low level of 1.86 million. We also got, of course, last week, the two national reports, one from ADP and the other from the Bureau of Labor Statistics. ADP says private payrolls grew 283,000, way above the estimate of 111. It was the highest monthly gain in more than a year. And it in the prior month of September was revised up to show 159,000 gain. So this was just across the board strong report from ADP. However, a couple days later, we get the Bureau of Labor Statistics report, and depending on what message you want to say in the media, as we're in an election cycle, you could look at this as bad, and I just don't. The October non-farm payrolls came in at 12,000 after a 223,000 gain in September. Prior 2 months were revised down. So yeah, in the headline, it looks bad. But remember, we had hurricanes affecting the entire southeast part of the country with especially detrimental effects in Florida and up in North Carolina. Even in the mountains of North Carolina, we had this just horrible, horrible situation. 512,000 workers unable to work. 1.4 million who usually work full-time could only get part-time work. And so it just was reflected in that report. I would consider that not a cyclical indicator of a decline in the health of the labor market, right? It's just not. So if it were persist for 2 or 3 or 4 months, then yes, of course it would be. But this is not, in my opinion, indicative of a poor labor market. Personal income spending, very important components to GDP, by the way. Personal income up 0.3% in September after a 0.2 increase in August. Personal spending strong at 0.5 and 0.3 in August as well. We got third quarter GDP, was expected to show 2.9%. I just love 3% for some reason. That's just really great and robust. It came in at 2.8. That's pretty darn close. Personal consumption, though, way more than 3 at 3.7. And that is important. Remember, GDP is consumption, up 3.7%. Investment, that's capital expenditures. Government spending, unfortunately, very high, and deficit, which causes inflation and accumulates into the debt and poses challenges down the road. But 3.7% on the consumer side is really, really, really good. Although on the government side, growth was also aided by a pretty high level of defense spending. All right, moving on, personal consumption expenditures. This was the most important data component of the week. This is the inflation metric that the Fed uses to determine whether or not they are meeting their statutory mandate. Their statutory mandate is to foster an environment of price stability. The Congress didn't define price stability, so a few years ago, the Fed decided to define it on its own. They say, we like this index, the core PCE price index, and we define stability as 2% inflation. I would define it as 0% inflation, but I get the reasoning why. Okay, so 2%. Let's first look at the headline PCE. That includes everything. That's food and energy in there, up 0.2, and now 2.1% year over year. That's the blue line, 2.1 year over year. But their measurement is the core, and that's 2.7, and it was hotter than expected year over year. To be fair, blue is going to be more volatile because it has food and energy. Energy has come down a little bit, although not so much last week. And so the blue tends to lead the red higher and then pull the red lower. So their argument is, look, we're seeing the headline number come down. It means it's going to pull the core number down with it. And I think it's a reasonable argument. And it's why they said, hey, we're going to start cutting rates in September. We're going to get ahead of the next problem. The next problem would be job losses if we kept these interest rates artificially high or higher than the neutral rate. Others would disagree with that. The same thing looks like the Taylor rule is an example, which dictates a Fed funds rate on a rules-based methodology, which is very valuable. Topic for another podcast. But we are still above the Fed's gauge, and they started cutting rates. They also started cutting rates right ahead of a presidential election, which would only be seen as aiding an incumbent. Moving on to manufacturing, Chicago PMI for the month of October fell to 41.6, not a very good reading. 50 is the line between contraction and expansion. We have been for the better part of 2 years, more than 2 years, in manufacturing contraction, not only in Chicago, but if you look at nationally, this is the S&P Global Manufacturing, still below 50. You can see it goes really a couple of months above it, of course, but all the way back about 2 years again. showing that manufacturing, is it cyclical? Are we entering a recession, or is it secular? Or is it related to trade policy where there's just a competitive advantage in countries with lower labor costs and lower environmental restrictions, et cetera, like China? And therefore, this is more of a secular issue versus a cyclical one. I think it is more secular. I think it's a big part of this presidential election. We're talking about this with the tariff discussion, as obviously. ISM, Institute for Supply Management, their manufacturing gauge for the month of October really showed the same thing. Better part of 2 years, completely below 50, slow, steady contraction, secular, not cyclical, in my opinion. Construction spending in September up 0.1%. Second straight month, 4.6% higher on a year-over-year basis. So last week, I said something in the headline of the email that goes out to announce that this commentary is out there. Is it time to reassess your model? And I want to reiterate that again this week. When you got into one of our portfolio models, it could be as long as 20 years ago, right? You should be reassessing the appropriateness of your model on an annual basis with your financial advisor. My view is generally as we get older, we move closer to retirement, we move to the point where we're no longer having W-2 income or business income, and we're then relying on our investments. As that happens, you need to slowly de-risk your portfolio. Less risk-seeking assets, more risk-reducing assets. The risk-reducing assets, the most common one is U.S. Treasury bonds. U.S. Treasury bonds are what I call a risk-free asset. 10-year U.S. Treasury bond, risk-free, pays 4.27 as of right now, as of this morning. If you put your money in a U.S. Treasury bond for 10 years, you got 4.27%, absolutely no risk. Well, there is a risk. The risk is inflation eats away at that return, so your real return is a little bit lower. But let's look at the earnings yield on a risky asset, the S&P 500 or SPX index. That's the purple line. The earnings yield is the inverse of the price earnings ratio. It's earnings divided by price. The earnings divided by price is about 3.8%. So you take risk in the equity markets and you get paid an expected 3.8, not a guaranteed 3.8. If you take no risk, you get a guaranteed 4.3. So in a very simple model, in a very simple world, in a purely academic model, you should be overweighting towards bonds and underweighting from equities. But the world is not exactly perfect, and academic models are just for teaching and understanding purposes. Earnings could come in way ahead of expectations, and then the earnings yield would then just drift higher naturally. That's possible. Interest rates on the 10-year Treasury could drop significantly if inflation data comes in better than expected, or suddenly the government realizes fiscal responsibility and borrows less and spends less. That would help bring interest rates down. And so the question is not, do you make this big absolute move? I've always been not in favor of absolute tactical moves with stocks and bonds and portfolios. But as you get closer to needing to spend your money, it is appropriate to begin to slowly take less risk off in the portfolio. And when you see a valuation gap as high as this one, it's a pretty substantial valuation gap. It's just a good time to remind people about the need to do that on a regular basis. Now, if I were to zoom out for 5 years on that same graph, that's what I was just showing you over there on the right, 427 versus 380, you can see going back 5 years, the purple, meaning the earnings yield of the S&P, is almost always higher than the risk-free yield. Why? Stocks are risky. You need to get paid more to take more risk. And that's generally over time and how all the academic textbooks are going to show it to you. It just doesn't always work out exactly that way. We've been a period here, look at that period where the earnings yield was higher, yet we know in 2024 stocks still did well and still outperformed. So don't take this as a tactical recommendation. It's not. But call your financial advisor, see if you're in the right model for where you are. You are 5 years closer to retirement than you were 5 years ago, or 20 years closer than you were 20 years ago. Now, finally, it is election time, and we are in the presidential election. Tomorrow is the day. This is the latest no toss-up map from Real Clear Politics. A couple of weeks ago, I said it's more likely than not that Trump will win, and the numbers were really bearing that out. The electoral map with no toss-ups was showing Trump-Vance at about 318. That number is down to 287. That still favors Trump. You need 270 to win. But tomorrow is the election. We'll know more then. Moving on to the betting map, the betting markets. You can see also when I made that statement, here was Trump at over 60%. Harris was down at the low 40s. And that has since changed significantly in just 2 weeks' time. Harris has moved up to 54. Trump has moved up to 52. And we'll know, hopefully we'll know on Tuesday night, tomorrow night, what happens here. And then we can start taking a look at likely policy outcomes, likely tax outcomes, likely spending outcomes, likely interest rate outcomes. We want to know the balance of power in Congress. We want to know the likely legislation. The promises made in the last 2 or 3 weeks of election are not worthy of anybody's consideration. We know that. We have a Congress. They make the tax and spend laws. Those will greatly impact our portfolio. The president will sign or veto whatever legislation comes from the Congress. Lastly, we are getting deep into earnings season. We've had 351 of 500 companies report. Average earnings surprise is about 7%. 265 of those 351 have beat. This is good. But remember, a lot of these big outsized earning gains in the last couple of years have been driven by big cap tech. Here is tech. Average earnings surprise there is basically nil. That's about 2%. Now, communication services, I got to admit, 13% is pretty good. But perhaps this just gross outperformance by the Mag 7 is getting a little long in the tooth and maybe to an end. We are definitely seeing the broadening out of the market. Plenty of economic data this week, but the most important of all, two things: the election on Tuesday, we know that, and then on Thursday, the Federal Open Market Committee rate decision. That's the Fed meeting and their decision on short-term interest rates, likely going to cut either 25 or 50 basis points. I think it's unlikely they do nothing, but it's still a possibility. Thanks, everybody, for tuning in. This is available on the YouTube channel, Slaying Bulls and Bears with Herb Morgan. We try to make the complex and complicated simple and sensical. Also available as a podcast in any of the podcast formats. Thank you. I'll be back to you again in 1 week.